Good evening, everyone, and welcome to the latest competition, the Clash of the Titans. We had to miss 1 year, unfortunately, due to the pandemic, but no longer. No new variant can actually do against our long-running and established competitions. So I'm really pleased that you're all here with us today. And we have an excellent panel today that will be able to help you with the completion of your competition entries. There's some reminders and details of how you can fill in your competition entries in the chat box. There is also a space in the chat box for you to ask the questions that you have of the competitors. So please do that as soon as you think of a question. Just send it in as early as possible so we can collect them all together. But without further ado, let's start with the presentation of the panel as the first part of this event. This is very exciting. Probably not that exciting these times, and not that exciting for economists in the sense that so much is really not dependent on economics when you're trying to forecast the outlook for the next couple of years. For start, there's quite a lot of science about pandemics that you need to get to understand, and then trying to predict what the governments are going to do about it, whether they listen to the advisors or not. And then we also have other things to worry about. There's more tension globally around the politics and some potential surprises on the military side, even when it comes to some threats that we could have later on. And I think maybe some of our panelists will talk about this as well. So there's a lot going on, and not much of it is economics. So with that, we've got three brilliant economists to try and unravel all of this for you and try and help you a little bit with the competition this year. So let me start with our first panelist. It's Linda Yu. You would know Linda from our previous competition. Linda is a fellow in economics at St. Edmund Hall at Oxford University, and she's also the adjunct professor of economics at the London Business School. And apart from her academic work, she's also TV and radio presenters, including the BBC Radio 4 and the World Service that you may have seen her or heard her on as well. She has served as a chief business correspondent for BBC News, as well as economics editor at Bloomberg TV. And she's also published a book, The Great Economists, How the Ideas Can Help Us Today. That was the Times Best Business Book of 2018. So Linda, let's start with you. And let's hear what you think the next year is going to pan out as.
Thank you very much. And it's very good to be back for this really, I think, just, it's always such an interesting event to really highlight what might be coming up over the horizon. Now, of course, yeah, as you've said, it is a very unusual time. I think lots of economists have become amateur epidemiologists. So I think I'm going to give you my first caveat before presenting at least where some of the indicators might look like in the coming year. So the first caveat is you kindly mentioned my book, The Great Economists. The Great Economists, I'm going to quote one, J.K. Galbraith said, "Economic forecasting exists to make astrology look respectable." And he was speaking during normal times. And these are highly uncertain times. So, I think that's probably the first thing to stress, which is as you rightly say, the business cycle now is heavily influenced by vaccinations, by periods of restrictions, and not just in this country, but also what's happening around the world. So I think that, this makes forecasting even more difficult. So with that huge caveat, let me sort of give an overall picture, I guess, of where I think the economy is headed. And of course, like everyone else, like my fellow panelists, I'll be looking at GDP growth. These are all quarterly. Then I'll look at inflation, year-on-year change, unemployment rate, interest rates, earnings growth, and then a couple of thoughts on the sterling exchange rate plus black swan event. All my forecasts are actually from either consensus forecasts, the Bank of England forecast, or the Office for Budget Responsibility. So I have taken essentially the consensus and the official forecast, and I'm going to map out the picture of what we might expect for the UK in the coming year. So in very broad strokes, this year's, so we've got one quarter, the current quarter that we're in, to forecast. So I've got about 1.3% growth in this quarter, but I think because of Omicron, I would say this is hugely uncertain. But I wanted to give you the broad sweep first, which is I've got, looking at the consensus and Bank of England forecast in particular, the first 2 quarters of next year essentially pick up a slowing growth rate, still very high, but slowing. And the driver behind it is we are probably in the first 3 months of next year, 2022. That's when we will recover to 2019, so pre-pandemic levels of output. So as we're starting from a lower base, the rebound in growth, the excess demand, the relaxing of restrictions, the vaccination rate, all that's contributing to a rebound this year and next year. However, over the longer term, you certainly see that in the OBR forecasts, the growth rate reverts to trend. So really 2%, below 2% from 2023 onwards. So that deceleration is part of this rebound, and therefore having very strong growth rates, in fact, above trend growth rates for this year and next year need to be viewed in that context. Because you're trying to recover about 2 years of lost output, and actually potentially more, depending on the assessment of the impact of the global financial crisis. So starting from a lower base, I think that gives a sense as to why growth is stronger this year and why it begins to peter out as you recover to 2019, and then growth begins to go back to what it was pre-pandemic, so the trend growth rate, as it were. So generally speaking, that arc means that growth, again, completely could be thrown off course by Omicron, should slow, peaking in the first 3 months or so. But again, with Omicron, it's just very, very uncertain, and then decelerating. Now, inflation follows with a bit of a lag. And again, these are Bank of England forecasts. So they've obviously upgraded their forecasts on the back of inflation, which is clearly above trend and likely to continue to be, and probably approaching about 5% in the first half of next year. So the challenge with thinking about the inflation forecast, in one sense, if you have above trend GDP growth, why wouldn't you have inflation that's also higher than trend? But there's a couple of, I would say, sides to think about inflation to determine whether or not inflation then drops off again towards the latter half of next year, because that would imply it's transitory, or how much of it could actually be permanent, in which case it would throw off some of these forecasts. So on the demand side, inflation is higher, as I say, because you have excess demand, above trend growth. It's the supply side and the distortions from the pandemic. I think those are the the supply side drivers of inflation. So for instance, the World Bank estimates about 8% of the world's ships are just in the wrong place. There was also an under provision. So firms have underestimated perhaps the degree of the rebound in growth. There's also supply chain bottlenecks stemming from border closures, which are still happening due to the pandemic. I think when you take the supply side factors together and then you look at the demand side, I think that, roughly speaking, looks like the supply side pressures, the ships will eventually move back to where they need to be. Supply chain should start to loosen. There should be more investment coming into that side of it. And then as demand begins to come down, perhaps price pressures would come down as well. And I think that's, generally speaking, where those forecasts are being based on. But how you would determine whether it's transitory or permanent, I think that is absolutely worth looking at. In some central banks, not just here, but also central bankers elsewhere, are beginning to look hard at what is the transmission from the transitory to the permanent, embedding a higher degree of inflation. So the very first indicator to look at is core inflation. If you strip out volatile items like energy, like food, core inflation is also above target now, and it's also above target in the United States. So will this translate into a higher permanent rate of inflation? And throughout the forecast, well, it highly depends on inflation expectations. So inflation, roughly speaking, you look at your cost base plus a margin, so markup, and then that gives you inflation. So the cost base depends on people's expectations, what they think their wages will be, which I'll come to in a moment, what firms think their costs will be, because cost inflation is also very high. And if inflation expectations change because this above trend inflation, according to the OECD, could last for 2 years, then you start to see the translation of some of this into a greater degree of permanence. So I think those are absolutely what to watch for in order to determine if inflation is going to subside or at least begin to come down. It won't be close to target anytime soon, but at least begin to decelerate. So another key factor is, of course, unemployment rate. So the forecast that I have here, again, taken from the Bank of England, essentially takes unemployment and sees a declining rate throughout next year. So really peaking around this winter and then beginning to come down. And so, of course, lots of factors go into this, including the furlough scheme, and that has prevented unemployment from spiking to some of the higher levels that were a huge source of concern when the pandemic lockdowns began. So the furlough scheme ended already, and we haven't seen a big jump in inflation over the last couple of months. However, a survey of firms just out today, and I think it's probably not alone, suggests that firms are actually waiting to see whether or not they will keep the employees that they have. In fact, one survey I saw, a small-scale survey, found that of firms that are run by owners, so smaller companies, 1 in 3 are contemplating letting people go in the next few months. So this is the key indicator for whether or not we have scarring from the pandemic. So unemployment can generate hysteresis, which is how you translate a negative short-term shock into longer-term permanent scarring. So in the assumptions behind lots of the forecast by the OBR and others is an assumption of a degree of scarring. So unemployment, keeping people, keeping unemployment down, keeping people attached to the labor market, supporting viable firms. I think all of that is very important to think about. And I think the degree of support that has prevented unemployment from spiking, that's why you see unemployment, which is also a lagging indicator, begin to come down. But that is, as I say, dependent again on what happens with the variant and what happens with these firm intentions, because almost a large number of firm surveys also show that a lot of firms have changed the way they operated. They have done more things online. They've adjusted to working from home. So it's a period of structural transition in the labor market, which also makes forecasts a bit challenging, because you could have frictional unemployment, so people moving from one sector to another, adjusting to new ways of work, accelerated adoption of technology, and probably possibly moving out of urban areas into other areas. All of that suggests there's going to be a degree of probably frictional unemployment here as well. So that's my sort of unemployment take, and that is the a absolutely crucial factor, how people fare in understanding where the economy might head. So just quickly on that point around earnings growth. So the earnings growth estimates I've taken from the OBR. Earnings growth, is predicted by the OBR to be 5% this quarter, and then decelerates to just over 4%, and then to just under 4% in the coming months. So having earnings growth increase in a tight labor market. So again, even though we have had the furlough scheme, people who no longer are on payroll work, we also have, by all accounts, a tight labor market where it's actually a competition for talent, and you hear the term the Great Resignation. So it's not unusual, especially with high inflation, that you would expect in the tight labor market for earnings growth also to be higher, because obviously earnings growth, generally speaking, hasn't been that strong over the past decade or so. And the UK is not alone. Germany, the US, they've had longer periods of tepid earnings growth. But when you match this against the high rate of inflation, real wage growth, is not going to be nearly as high as the nominal wage earnings growth indicates, because inflation, as I said a moment ago, is 4%, could reach 5%, or thereabouts. So this earnings growth of being, 4% or less, that gives you a sense as to what the real impact on income that might be. So obviously, with earnings growth, you need higher productivity. It's the real earnings growth that matters. So you need to take out the impact of inflation. And I think that goes to a longstanding structural challenge for the UK, which is how to raise productivity and then ensure that the wage growth that's there can be sustained. But I think I'm running out of time. So let me just kind of say, I think that's where the trend is. And then just finally on interest rates, because of the fact this is a rebound from a low base, and given all the uncertainty about variants and vaccination rates around the world, the IMF forecasts that actually it's going to take about 2023 for the world economy to get back to pre-pandemic levels. So that means for developing countries, there could be 4 years of lost output growth. And until the pandemic is addressed everywhere, it's going to continue to be an issue. So I think all of that uncertainty is why the the consensus view on interest rates are going to go looks very uncertain in the immediate quarters, because once the Bank of England embarks on a degree of normalization, I guess you would continue that path as opposed to having to reverse course. So very slow normalization of interest rates, kind of ceteris paribus with the variant is what I have put into my forecasts. But perhaps we can discuss that a bit more during the Q&A. Sterling euro exchange rate, I put 1.1. That's again quite uncertain. And then may as well just finish with the most uncertain, the black swan event. So it kind of feels like the whole past 2 years has been a black swan event. So my black swan event for the coming 4 quarters is a climate emergency that leads to an economic shutdown. So with that, I will hand back to you.
Thank you, Linda. Just added another potential shock for us that I haven't mentioned. That's very interesting and potentially, very topical for us on climate dangers that we haven't talked at all about so far. Yes, indeed. So I'm hoping that we will get more questions on your black swans. But before we go back to that, let me introduce our next panelist. He is Douglas Mcwilli, and Douglas, welcome to the competition. Douglas is the founder of the Center for Economics and Business Research, CEBR, which he founded in 1993 and established as a leading think tank known for its expertise in forecasting. So we have great hope from you today, Douglas. He is currently the deputy chairman of the organization, having previously held the role of the chief executive. And prior to that, he was the chief economic advisor to the CBI, as well as also the chief economist at IBM. And he also served as the Gresham Professor of Commerce. So Douglas, welcome. And the floor is yours.
Yael, thank you so much. If I may, I'm going to share my screen. So let's just see if that works. I'm sorry, all sorts of things emerge. Is this now here? Can everyone see slides?
Yes.
Good, okay, thank you so much. I'm going to say a few things about the global context. Then I'll talk about the UK and I'll finish off with the forecast. And I think actually the forecasts in some ways are the least interesting thing. I think it's more what's going on because as Linda has just explained very eloquently, there are so many different things going on at the moment that it's very much a shot in the dark, whatever we say. The way I'd like to start is describing the growth in the US money supply, because we've had this pandemic. I think the authorities have played an absolute blinder in preventing the crisis from turning into what could have been cumulative deflation. They acted both fiscally. In the UK, we had furlough, they had checks sent out by the president. In the US. The sort of effect was relatively the same. But one of the biggest things operating in the background is a massive expansion in the money supply in the United States. And that gave cover for an equally massive or nearly as massive expansion of the money supply in so many other countries. And what that did is it created a stable position for asset prices so that as a result, the property market has gone up, share prices have stayed reasonably strong, even the bond markets have stayed reasonably strong. And that has prevented the crisis from turning into a rout. And I'm full of admiration for the authorities. I think they did the right thing. And I think you'll never know, we will never know what would have happened had they not done that. But there was certainly a risk that we could have moved into something not all that different from the 1930s. We didn't get that, and that is a great result. However, the authorities have been quite slow at realizing that they had a success on their hands, and that was the time not to get too greedy. And in the US, I'd say there is an inflationary monetary overhang of about 20% compared with where they ought to be. And that will either be sorted out by the money being rolled back, or it will be sorted out by a new level of velocity of circulation, or it will be sorted out by higher inflation. We'll get one of these things. Mathematically, that just has to be the case. And of course, we had the latest inflation figures that came out in the United States last week of 6.8%. As Linda pointed out, the world has recovered quickly, more quickly than the authorities expected, although some of us in the private sector had made this prediction a year ago. And I'm slightly surprised the authorities were so slow to catch up, but there they were. Whether inflation becomes long-term is, again, as Linda very much said, it's whether it turns into a change in expectations. Once rising prices mean that people adjust their behavior on the expectation of rising prices, that's when you get inflation becoming endemic. And that's when the measures that you need to take to slow it down become very much more aggressive. You can't just adjust interest rates, have a little bit of tapering, have a very slight rise in interest rates, and hope that growth will subside gently and inflation will go away. If inflation gets built into the system, we'll have to have something pretty close to a recession to turn it off. And what I've shown in this slide is as a base case, which is, I think, roughly the same as all of us are saying, effectively, that we can get back to normal without too much pain. And then I've contrasted an alternative, which has world GDP growth falling in 2023 virtually to zero. The expansionary policies were both fiscal and monetary. I think counter-inflationary policy is likely to be mainly monetary. Fiscal deficits are gradually being reined back. I'm not expecting that they will play the major part in trying to deal with any inflation. I'd like to put forward a second proposition about which I feel much less certain, which is that if counter-inflationary policy is likely to be mainly monetary, the transmission mechanism will be mainly through the asset markets. I'm thinking in terms of asset prices dropping by between a fifth and a quarter. And I think if that happens, it may be that we don't actually have to have a huge rise in interest rates to achieve this result. Because if a small rise creates this impact in asset markets, then the movement in the asset markets will be the thing that generates the turn in inflation pretty well automatically. And of course, we have no real recent experience of moving interest rates up from the levels that they are at the moment. I mean, now they're virtually at zero, but I'm just going to play a thought game. Is a rise in interest rates from 1% to 2% merely a 100 basis point rise, which would normally not have a huge impact? Or is it a doubling in interest rates, which would normally have a pretty big impact? It's actually both. And we are not 100% certain which of the two things will dominate. I think it will be a bit of both, but I think there'll be a slight sense in which a relatively small rise could have quite a significant impact on asset markets, which are fragile at the moment anyway. Now, two other thoughts on the international economy. The first is that traditionally, when you go through the tightening phase in policy, there is a disproportionate spin-off onto the weaker economies and onto the emerging economies. And if that does happen, then I can see some people who already actually had quite a lot of the negatives from the pandemic, who've had less luck in getting the spread of vaccinations working in their favor. A lot of people have been pushed back into poverty. I can see the potential for that group of people starting to be disproportionately affected by counter-inflationary policy as well. I think that's something we need to be very concerned about, not just from the point of view of economics, but from the point of view of global citizens. And the final thing is that the Eurozone has actually behaved so far in a way which, in my language, defies the laws of economic gravity. The strongest economies in the Eurozone, Germany, of course, is traditionally the strong one, have been the ones who have been hit most in the past year the two economies that you would normally think of as weakest, at least in terms of past performance, in terms of indebtedness and so on, have actually done best. Italy and Greece have outperformed. Why have they outperformed? Well, essentially the fiscal rules have been abolished for the time being, and the thing that's constrained them have been the fiscal rules. Also, there is a sort of automatic bounce back that if you've had 10 years of depressed economic growth, there is always bound to be a bit of a recovery at some point. But the question is, does that continue if we move into a world of greater austerity? And I think that's very much a question for the markets. And the markets will have to make a decision about the credibility of the euro and of the ECB. At the moment, I think their view will be that they are credible. And so I think they'll probably back them. But it's always in the background that if they lose faith, then the loss of faith can have quite major impacts. So we're going back to what we were talking about earlier, which is the fact that it depends so much on expectations, and expectations could be self-fulfilling. And then, of course, around the world, we've got, I mean, the US president is perceived as weak. And in those circumstances, there are three in particular interesting situations. There's China and Taiwan, there's Russia and Ukraine, and then Israel and Iran. Now, particularly if there is a fear that Donald Trump may come back in 2024, and a fear enhanced by it looking as if the Republicans are going to do well in the midterm elections in the US next November, it would be tempting for some people to decide to take preemptive action rather than have to deal with an irate President Trump. So these create further uncertainty. For the UK, we're much in the same situation. Our growth this year is going to be a bit below 8%, which is what I expected to be at the beginning of the year. It's going to be a hell of a lot greater than what the OBR thought even in March. I still don't quite understand why their 4% growth forecast in March was so off-beam. I mean, all the evidence should be enough by that stage for them to get it closer to being accurate, but there it is. We'll either have growth subsiding gently, which is the scenario Linda's described and which is my base forecast too, or else again we'll have to do what they have to do and what they may well have to do in the States, which is create a recession to deal with inflation. And the red line reflects the latter. I filled in an entry form like anyone else, but I do have to say that I'm fairly skeptical about these very short-term forecasts anyway, because the data gets changed so much. One of my recent publications, a book called The Flat White Economy, which is about the merge of the digital and the creative economy, initially in the East End of London, although it's spreading around not only the UK, but also lots of other countries as well. But the point about that economy, which we reckon has contributed between 1/2 and 3/4 of the economic growth in recent years, that economy almost always doesn't get into the statistics until about 2 or 3 years down the line. So there we are, who knows. One final thought, Dilip normally wins this competition, and I'm not quite sure, I sort of feel that he ought to be handicapped really, because he is clearly very, very good at this. And if you want to work out who is going to win the competition, my suggestion to you is not bet on anyone but Dilip, because he normally wins. So you've got words of wisdom from Linda, accuracy in forecasting from Dilip, and the only thing I've got to offer is the fact I was around before when inflation really took off. So I have a very slight advantage there, but it's only a minor advantage compared with my two eminent colleagues. Thank you very much.
Thank you so much, Douglas. And we can quiz you a little bit more on your fears of inflation a bit later, and hopefully there'll be some interesting questions from our audience a bit later on. So as you said, we also are very privileged to have Dilip Shah here with us today as one of our presenters. And Dilip has been an economist for over 15 years, working both the public and private sector. But more interesting for us is that he has been a regular entrant of the public Clash of the Titans forecasting competition, and he won the overall competitions on 2 occasions already, and almost always ended up in the top 10 with forecasts that were barely different from the real data. So I advise all of you, including myself, given that I am also a forecaster in my day job, to listen very carefully to Dilip. Thank you.
Okay, thank you for those warm words, both Douglas and Yale. I'll share my screen. Okay. You can see that?
Not yet.
Not yet.
Your screen's going dark, which may help.
No?
No, not yet.
I'll try again. You can't still see it?
We could, oh, now.
Oh, you could see it. Okay.
Oh,
Now?
now,
Is it still...
yeah.
That's brilliant.
Okay, that's fine. Thanks. So yeah, I'll kind of talk you through the different variables and the reasons for my forecast. Starting off with the kind of background, Linda's kind of made the similar point that we're not in a traditionally kind of forecasting game where you can use past presidents to kind of forecast the future so much. It's a shocks-driven economy, driven by kind of how the pandemic is evolving and the policy measures in response to that, and also the private sector reaction. And we can see this from this graph, which looks at monthly GDP change. You see that the first one, first time we had a lockdown, it was in March, but the full effects were in April. And in April, the UK GDP growth fell by 19%, which was unprecedented. This even in the kind of global financial crisis depths, like at most we were falling in terms of monthly output by 2%. So this is kind of completely unprecedented, and the reason for that is, for the first time, we had an economic lockdown where effectively the policy mandated that parts of the private sector activity were banned. So that's why the effect here was so severe. And once the lockdown was lifted, then you had a very sharp rebound, and these monthly growth rates again are unprecedented, just because the depth of that hit was so sharp, and the rebound was sharp. But what we noticed is that then kind of later in 2000, we had like a light touch lockdown in November 2020, and another kind of proper lockdown in January 2021. And those had smaller monthly effects. But there are kind of three reasons for that. Firstly, we hadn't fully recovered to the pre-pandemic rate. So effectively, the economy was already kind of operating under capacity, but the policy making became a little bit smarter as well. So rather than just locking down everything, it was better targeted at kind of minimizing the economic damage. Then the private sector reaction was a little bit different. So in April 2020, for example, the private sector became very cautious. We kind of saw the scenes from Italy, for example, and originally China, of many people dying, which was very shocking. So even if the lockdown arguably hadn't occurred in April 2020, there would have been a big effect on the economy. Probably less than happened, but I mean, we saw, for example, in the depths of April 2020, that the building industry, which was actually legally allowed to operate, they basically stopped. So even the private sector was very cautious. But by kind of November 2020 and particularly January 2021, the private sector was better prepared. I think people started to understand what works and what doesn't work in kind of cutting down transmission without completely destroying the economy. So this is why the impacts subsequently were smaller. Then kind of looking forward from these kind of lessons of the last 18 months, well, what can we think of Omicron's effect on growth? So what do we know about Omicron versus the previous waves, and particularly Delta? It has faster transmission, which is a negative in terms of the economy. It has more vaccine resistance, again a negative, but I mean, the UK government hasn't yet acknowledged this, but there have been a number of areas like the EU, the US, and South Africa where Omicron originated. I mean, originally it was called the Botswana variant, but I mean, it was sequenced in South Africa. But all these three countries or areas, they've kind of confirmed at least that it's less virulent than Delta. So that's a positive. So the case per case, we may expect less hospitalization, even though we may have a lot more cases because it's more transmissible. But anyway, even if we think of the effects before Omicron, already in kind of the last 3 months, if we compare the last 3 months with the same period last year, each COVID-19 case is 4 times less likely to result in a hospitalization. So at this point last year, we actually, I think, had about 30,000 cases. Today we have over 50,000 cases, but we have about half the number of people in hospital, and that's likely because maybe I think there is kind of protection either from the vaccine in most cases or from past infection. So the second time you get COVID, you're probably likely to have antibodies as well. So you're less likely to experience such severe conditions which result in hospitalization. So I mean, this is why, I mean, this time last year, kind of in November 2020, as I mentioned, there was a lockdown, and the threshold was when at 25,000 cases. We now got like cases closing in on 60,000 already, but we have no lockdown. We're just having kind of light touch measures, kind of vaccine passports in nightclubs and masks indoors. So yeah, but the problem is that because of the faster transmission, and we kind of know that 40% of London COVID cases are Omicron already. That's kind of expanded from 10% just last week. So it's Omicron is going to take over from Delta. We know that, and it's kind of, if we think of that, you're 4 times less likely to be hospitalized now. The kind of, if the objective is to protect the NHS, then the lockdown threshold, which was 25,000, is now 100,000. But then because of the faster transmission, we're likely to hit that in the next few days or weeks. What the government has done, it was actually ineffective in even halting the spread of Delta in Europe. So masks and vaccine passports, these things were introduced, and actually the vaccine passport was more severe in, for example, France, where you needed a vaccine passport to enter a large supermarket or restaurant even, and even that didn't work, and they had to introduce kind of lockdown type measures, curfews, similar things in the Netherlands, Austria, Germany. So these kind of light touch measures haven't worked. So I wouldn't be confident that they would work. If you look at the kind of data on Omicron so far, it's kind of intrinsic R rate, reproduction rate, each person can infect on average 3.2 people. That's very high. Offsetting that, the vaccine protection has waned, so it's more vaccine resistant, and a recent study suggested that double dose of AstraZeneca, for example, has 0 protection, double dose of Pfizer has 35% protection. So kind of in response to that, we saw this kind of TV address by Boris Johnson yesterday evening recommending people to get triple dose vaccination or boosted. And that does offer 75% protection, but that kicks in after 2 weeks. The bad news is that this 75% protection would kind of, for the vaccinated, knock the R rate down from 3.2 to 0.8. So it's basically 1 minus 0.75, which is 0.25, a quarter times 3.2. So you're getting to 0.8. But then kind of there would be some holdouts of this triple dose. And effectively, if you do the numbers, you need 90% of the population triple vaxxed if you're wanting to bring the case growth back down, the case numbers back down to get R below 1, which, I mean, to me at least, you've seen the long lines in the NHS of people wanting to get triple vax, but to get a 90% rate is kind of, doesn't seem that realistic. Furthermore, you kind of, you're kind of, that immunity kicks in after 2 weeks. So, and what has been announced is kind of an ambition to complete this kind of, that everyone can have the vaccine by the end of the year. But again, you need a million people every day being vaccinated. The UK at most has vaccinated 500,000 people a day. So this target may not be met until more reasonably mid-January, even if everyone takes it up. So, I mean, my kind of analysis of this is that there is likely to be additional restrictions and a light touch lockdown, kind of like November 2020 required. And this is the reason why I'm kind of expecting in kind of December, January, to be a kind of I mean, the definition of a recession is 2 quarters. So it won't be a real recession, but there'll be a dip in monthly output around here in the depths of winter. One kind of good news from Omicron is that it's less severe and faster transmissible. So we kind of expect it to go through the UK population much faster, even with the restrictions in place. So what you'd expect is that it may actually kind of medium term. When I talk about medium term, I mean kind of 3 to 6 months out. It could accelerate the transition to herd immunity, where without restrictions the economy can operate. So we may be able to actually abolish all restrictions by Q2 because it just goes through the whole population very fast. So I mean that's my growth outlook. But well, now I'm moving on to unemployment. Kind of a background is that the UK's unemployment situation has been progressively improving since the 1980s. So here we see these peaks, nearly 12% in 1983, then this just above 10% in 93. Then global financial crisis. It was a bigger recession than those previous two, but the peak was 8.1% about 2 years after the GFC. This one, we've had the biggest recession for, I think it's estimated 200 or 300 years, but because of furlough, and also because work has become much more flexible and not kind of organized through corporations. All these different factors have happened, like the reduction of unionization, better welfare to work policy. The internet facilitates quicker matching of employers and employees. You've got remote working offering greater opportunities, even like if you're not in the right location in the country. And then the biggest factor was furlough. That for the first time, the UK decided to subsidize people to stay in their workplace during a recession, and this resulted in unemployment peaking at just 5.3% in 2020. It's kind of now already come down to 4.1% in the latest data. So in that way, the furlough scheme has been very successful. But I mean, I personally, given this big trend, would have thought that, given everything else that was going on, we might not have actually seen unemployment spiking as high as people expected. Like NISA, for example, was saying without furlough, you could get 12% unemployment. Personally, I don't think that would have happened because, I mean, in the gig economy, if you're sacked, you have the opportunity to do something else. And I mean, as long as there were other kind of stimulus measures, maybe the unemployment rate might have peaked, still lower than GFC, even with such a big shutdown. Kind of moving on now to the next variable, which is average earnings growth. And what we actually saw with average earnings growth was also distorted by the furlough scheme. So the furlough scheme involved the government paying at 80% of workers' wages. The good news from that was it kept people in work. The bad news was that it kind of caused those people on the furlough scheme suddenly earned 20% less unless their employer decided to make up the difference. And that caused kind of average weekly earnings to suddenly drop back from about 3.5% to just 1% at the peak of the lockdown, when I think about 25% of the workforce may be on furlough. So that was kind of a big impact. Then as the lockdown slowly receded, it was eased. Then people on furlough kind of came back to work, and this kind of was the reason for this kind of recovery. This isn't the real data actually. So the actual data is released on a annual basis, but I produced a 2-year annual average earnings growth to kind of ameliorate some of these kind of distorting effects of furlough. I mean, the data is still distorted in this kind of big lockdown period, but then I've kind of managed to stabilize it, and this kind of paints more of an underlying picture of average earnings growth. What we kind of see is, despite what we've seen is vacancies are at a record high. So at the moment, we have 1.2 million vacancies. This is actually more people having job opportunities than pre COVID. In 2019, for example, there are about 800,000 vacancies. So it looks like there's more vacancies, but so far it doesn't seem, if you look at the underlying wage growth, that this is causing a big spike in wage inflation. So we're kind of meandering around this kind of 3 to 3.5% rate of annual earnings growth pre-COVID. We seem to have settled around 3.5% now on the underlying rate once you kind of use this kind of smoothing to get rid of the furlough distortion. Again, there's going to be more distortion coming. So 2021 Q1, so the first quarter of this year, we had a lockdown. We had more people on furlough. So that kind of depressed wages. So it'll be a base effect which causes average earnings growth to kind of be biased upwards again. So yeah, it's another area where these kind of policy responses are distorting the economic variables. So finally, coming to inflation, I'm not going to look at the historical picture that much, but other than saying that input and output prices are rising at an accelerating rate, and it's the fastest pace of input and output inflation that we're getting. So the input PPI is basically the goods that a factory uses to produce. The output is factory gate inflation, which is kind of what's leaving leaving the factory, the price of the goods leaving the factory. So I mean, and most kind of the volatility in inflation can usually be explained in goods rather than service inflation, which tends to be quite stable around 2.5% to 3%, whereas goods inflation, it can sometimes become negative. It can sometimes be kind of 5% positive. But I mean, from the pattern of previous times is that the commodity price peaks, and then with a 2-month lag, factory gate prices peak, and then only 6 months later, consumer price inflation peaks. So the fact that we're kind of having this big spike in the final quarter of 2021 means that at least until 2022 H2, the second half of next year, we can't really expect inflation to fall. And one big reason to reinforce that conclusion is the energy price cap. So today, the energy price cap is keeping UK energy prices below wholesale prices. But I mean, firms aren't going to sell you gas and electricity at a loss for the long run. So this price cap is adjusted every 6 months. And what's going to happen in response to the big increases in gas and electricity wholesale prices is that in April 2022, we're likely to see household energy prices increasing by 35 to 40%, and that's kind of result in another uptick in inflation in April 2022. Although this is a time when some of the other factors will, I expect, slightly ease off, because I've made the point that commodity prices have peaked. Like oil is 10% off its highs, but other things, other input prices are quite a lot off their highs. So you should kind of see some other indicators of inflation fall back. But this energy price cap is bound to keep inflation high for at least the first half of this year. So kind of summarizing the UK economy in 2022, the kind of positives, I mean, Omicron is negative, but I think that's kind of negative effect is confined to the first quarter of this year. And it could actually be a positive for Q2 onwards for economic growth, because it will accelerate the move to herd immunity and the time we can remove all restrictions. Then you've got a potential for business investment to boom, I think, in the later half of 2022. And there's two reasons for that. One is that COVID-19 has prevented some investment happening, which would have otherwise occurred. And also we've had kind of a 5-year period of EU exit uncertainty when UK business investment has been below normal. The surveys like kind of EY attractiveness survey, for example, they all indicate that businesses, rather than cancelling investment due to this EU exit issue, were actually delaying investment. And we already see, if you look at the foreign direct investment data, for example, that investment in the UK and sentiment in the UK internationally is actually picking up. So we can expect this to translate into a business investment boom in 2022, I think. There's also a particular tax measure. So in budget 2021, there was an enhanced 130% allowance for capital, plant and machinery investment in the corporation tax. So for every pound that you invest in business investment, you can offset that with 130% on your tax liabilities. So and that kind of comes to a conclusion in March 2023. So that would kind of cause a lot of businesses to invest in the second half of 2022 to take advantage of that before that measure expires. Offsetting this, we do have a cost of living crisis. I mean, my view is that real wages, although they'll be slightly higher in response to these record vacancies than pre-pandemic, because of the weak state of UK businesses, we're not going to see them be, and also the fact that the employer and employee national insurance is going up, the businesses just won't be able to put up wages too much. And then the consumer on the other, as well as facing kind of this kind of hit from higher tax burden, they're going to take the hit from the higher energy price. So there is actually a cost of living crisis here in 2022. So our kind of final slide summarizes my forecast, and this kind of confirms the cost of living crisis effectively in those two lines, inflation versus average earnings growth, kind of all of the quarters of 2022. I'm expecting inflation to kind of at least match or sometimes exceed average earnings growth. So in terms of your real purchasing power, it's already zero, and then you're hit by this increase in national insurance, which isn't actually reflected in the average earnings data, but would be affected in take-home pay. So, I mean, you're gonna get like you're gonna feel worse off now than maybe you were even in the depths of the COVID crisis, because of the stimulus measures turned into effectively an austerity measure with the tax rise. And there's a bit of austerity with the kind of benefits changes as well. So in terms of the economic growth that I'm forecasting 0.85%. I've adjusted that down because of kind of measures that have already been announced in December, and kind of consumers becoming more cautious. And also I think that growth was tending to peter out. So the last month of growth, we only had 0.1% in October 2021, and this was before any of this Omicron issue came up. So there was kind of quite a lot of evidence that the consensus was too optimistic for Q4 anyway. In terms of 2022 Q1, I've got a negative number there. That's explained by previously. I said that there would be some restrictions put on, but then we got a big bounce in Q2, and then that starts fading back as well. So yeah, thanks for listening to the forecast.
Thank you, Dilip, and thank you, three participants. I'm just going to while we're checking the questions, and please put in questions in the Q&A box, I've got a few questions for you myself as well. And maybe if we can start with the GDP forecast. One of the things that we're finding quite disappointing, if you like, is that we know that a lot of businesses were looking forward to that festive season where they were going to, in the run up to Christmas, they were going to potentially replenish the lost revenues that they suffered during the earlier part of the pandemic. So there was a lot of anticipation of good, if you like, a good Christmas season, especially for services. And in particular the hospitality services, and we've already seen even before any additional restrictions that are potentially going to be announced. If we are to listen to what Dilip is predicting for us, we've already seen quite a few cancellations in orders and bookings, etc. We are so far actually forecasting a small dip in GDP for December. The December month, although Q4 will probably be positive. So my question for you is really a little bit more about that beginning of next year. So the Q1, especially the Q1, if you're expecting, are you expecting more restrictions to be introduced? And if there are, how far are we going to go back to something that is more akin to Q1 of this year? For what I've seen for Dilip, for example, the drop is actually quite small compared to the first quarter of last year, even if we're going to have a slightly milder restriction. So maybe if we start with Linda and then move to Douglas and then to Dilip, and just to have a little bit of explanation from you on that bit.
Yeah, it's a really good question. I think, there's probably lots of, are these known unknowns? Anyways, they're definitely unknown. But I think part of the adjustment between the first quarter, because obviously, the lockdowns happened in March 2020. So the first quarter reflected a slowing of the economy in the normal business cycle, and then that picked up. So it's not quite a like-for-like comparison with the first quarter of this year. But I think what we have seen over the last 18 months is a greater ability to adapt to not all industries, as you rightly point out. Face-to-face services will suffer. If Omicron, continues to on its current path, the booster scheme, depending on the rollout of that, and then again, what happens globally. But if you are in an area or sector or industry that can deliver virtually, or you're in a business that can use e-commerce, your business has adapted to technologies, including supporting workers so they can work from home. I think so part of the lessening of negative impact from restrictive measures is because there's a greater ability of businesses to adapt and to be nimble, to switch to working from home or e-commerce or virtual delivery. But there will still be an economic impact. But I think probably the one certainty we have about the pandemic is that we can't be certain, about variants and how distribution is happening around the world. So I just wouldn't be surprised if, not just the first quarter of next year, but looking into going later on in the year, because remember, the world is unlikely to be vaccinated sufficiently by the end of next year, that we just have cycles where you have more restrictions. But I think it depends a great deal on those factors and how well, companies and people are able to adapt and to pivot into other ways of working and delivery in industries that can.
Mm-hmm. Thank you. And Douglas, you wanted to add to that?
Well, Dilip and Linda have said most of the things that need to be said, but I live in Kent, and Kent was locked down last Christmas. And I remember it distinctly. It completely changed the tenor of that period. It wasn't quite as bad if you happened to have the good fortune to be in London, but if you happened to be where I was, you had no Christmas. And actually nothing very much happened in the early part of the year either. It took till the spring until we were let loose. Although, I mean, being locked up in the summer is much worse than being locked up in the winter, I have to say. As Linda's pointed out, for quite a lot of the economy, it's not really affected that much. And that hasn't come without people doing a hell of a lot of work to make working from home, to make it possible for people to do things in a very different way. But for retail, for hospitality, and especially for travel, I mean, this is a body blow. And I think they're going to, the authorities are probably going to have to do something to try and help these sectors, because they can't go uncompensated when, even though the formal restrictions haven't completely shut them down, in practice, government activity will largely have shut them down. I think there's a second point that also, I think, reflects something that Linda's just said, which is that we're all in this together, and it's an international phenomenon. And I do think that one of the things that we will all have to start thinking about is trying to be more willing to share vaccines than has been the case in the past. I know it's not an easy thing to get right. There have been attempts to share vaccines which haven't succeeded, but nevertheless, it seems to me that until the world has got a decent vaccination system working, these things are going to be bouncing backwards and forwards. And that is an issue that we'll have to cope with.
Okay. Dilip, you've mentioned some of it already. I'm not sure if there's anything you wanted to add.
So yeah, I mean, just to kind of say this, I did mention that the impact of GDP on from this year's lockdown was much less severe than last year's lockdown, and I think this time it'll be, the private sector will adapt even better. But also, I think the government's focus seems to have changed. So there's been so much kind of focus on vaccination, and I think that this will work. So I may have been too pessimistic saying it won't work. It would work, but it'll get the R rate kind of, without this triple dose, the R rate would be kind of, rather than 3.2 unvaxxed, it would have been just over 2. But with kind of, I think it's realistic for the government to kind of be achieving over half the population triple vaxxed, and that would get the R rate kind of about 1.5 or what, so around that kind of level. So then you need low-level restrictions, so a light touch lockdown, not kind of a full lockdown you had in the first quarter of this year. So that's why I'm thinking that the kind of impact is going to be kind of quite low. It'll be like kind of the November 2020 lockdown, where we kind of like restricted businesses rather than shut them down. So that's why I kind of have only GDP going down by 0.3%. And also I think the lockdown can be ended very quickly. So as I said, we're not unlikely to meet the Johnson targets by the end of the year, but we may well kind of get to around 80% triple vax by the middle of January, given there's so much kind of compliance with this. We're seeing today, for example, all these queues. So that would kind of push the R rate to about 1.1 or 1.2 without restriction. So then you just have to have very minor restriction to achieve the rest. So I expect these restrictions, if they come in, the additional ones to be maybe only last around a month and then be taken off very quickly, unlike last year. I mean, unlike last year, and also unlike this year, where they kind of took about 3-4 months to take them off.
Okay, cool. I've got a few questions on inflation that came from the audience, and I'm going to put them all together and add a little bit on it as well for you to answer. So I just want to start just with your thoughts about whether the latest setback that we had with the new variant is inflationary or deflationary? Do you think that it's actually going to put downward pressure because there's less demand in the economy potentially, or upward pressure because we have more pressure on the supply chain and on ports, etc., as a result of further disruptions? And then to add to that, there's also a question on real narrow money in the G7 and E7 turning negative earlier this year. So stagnation or recession is predicted by this aggregate for the first half of next year. Any comments you may have on that one? Very helpful. And then I've got another question on inflation being over 4%. Based on the analysis in 2012, so is there not much greater chance of a higher inflation expectations to be baked in? Plus, with a large number of job vacancies, is it not more likely that unions will be more assertive, resulting in pressure for inflation to be even higher? And possibly we could enter into an inflation spiral. So, one of the big worries about inflation becoming more entrenched is through the wage part. And let me mute myself now and start the other way around, a bit shorter this time from you. If you can just pick one and start with Dilip, Douglas, and then Linda. Thanks.
Okay, in terms of the impact on inflation, I think the kind of Omicron, the evidence to date suggests it may put slight downward pressure on inflation relative to what would have happened, because as I kind of noted, the oil prices come off its high already. It's kind of come back down to $75 from 85. But the moves in some of the other commodity prices have been even bigger, and that's not completely related to Omicron, but also kind of the China Everglade collapse. So China is the biggest by far user of these commodities. In terms of the money supply, yeah, I mean, I see that kind of also moderating inflation, because the kind of the Fed is tapering, the Bank of England has stopped QE. They're all going to tighten in 2022 in terms of interest rates. So yeah, I mean, the monetary stimulus has ended. So yeah, I think the final point was what's the I may have missed. I think I've confused that with the Omicron issue. So yeah, I mean, I think the final point was about wages. Could there be a wage price spiral? Personally, there is a chance of that, but I think as there has been a pivot in the central bankers' language. You see that from Jerome Powell, for example. He's kind of now said inflation isn't transitory. So and I expect there to be kind of hawkish language and hawkish action. This may be slightly delayed by Omicron, but yeah, I don't see the kind of a 1970s style wage price spiral. There may be some effect, because if UK is a very low productivity economy at the moment, so UK productivity is averaged less than 1% a year. So even if we get nominal wage growth of about 4.5%, then that's more consistent with 3 to 3.5% inflation, not 2%. And we don't see goods prices collapsing like they did in previous periods. So yeah, I think there is a little bit of that issue, but not a 1970s style.
Cool. Okay, Douglas.
Well, a couple of questions are from friends of mine, so I better give them sensible answers, otherwise I'm going to be in trouble. Tim Goldfinch is a real monetary student, so he looks at these things in a lot of detail in his questions about narrow money. And my response is there's quite a lot of overhang in broad money, and I suspect the monetary overhang is such that we'll see a reflection. And my expectation is that will hit the asset market especially. I won't go into more detail now because he argues with me all the time anyway, but that's my answer to that. Bruce Wallen, you should know about Bruce because he's probably the person who's done more negotiations with trade unions than pretty well anyone else in this country. He used to be the head of personnel at Vauxhall and used to deal with all the motor industry trade union leaders. When, I mean, Red Robbo wasn't in Vauxhall, I know, but they were interesting people. He was also the chairman of the CBI's Employment Policy Committee. So when he's worried about trade unions, he's a guy who's got a bit of experience on that side. And my answer is actually, I think, except in the public sector, the unions aren't going to be so much the issue this time round. I think that the issues are going to be much more that employers are faced with vacancies. And one thing none of us have really talked about is the fact that the labour market does seem to have shrunk a bit. It's a sort of hysteresis, which Linda was mentioning earlier, but the labour market seems to have shrunk a bit, which has added to our difficulties. Now, I'll answer the other question, which you're not bringing up, since it's there sitting at the bottom, which is what are we saying about asset markets? What are we saying about the housing market? Well, if I'm right, and that's a big if, then it's not going to be great for the housing market.
Well, I'm really glad you managed to squeeze that answer as well, Douglas, because I was going to ask you that later on. And that's very interesting actually for the housing market, because there is something about the housing market with our shift to at least partially working from home that we have seen stronger demand, and we've also have this 180 billion of excess savings that we are likely to invest partially in the housing market. So maybe there'll be a little bit of support there for at least parts of the UK. But Linda, it's your turn.
Actually, I think my fellow panelists have covered a lot of ground. So maybe I'll just cover the question that you were posing. Can you essentially disaggregate what's going to happen to inflation from demand and supply side? I think, it's not implausible to think that if we get hit pretty badly at some point, maybe Omicron, maybe something else, it could be also be from abroad, that you could end up with much more tepid growth on the demand side. But these inflationary pressures are still in the system. So that's not a good combination, obviously, to have supply side price pressures, which should also begin to subside if you have less demand, because that's one of the drivers. But the other drivers are distortions and border closures and things, which, and underinvestment, net zero transition. There's a lot of stuff happening on the supply side, and also that labor supply point that Douglas just helpfully raised. So I think it is possible to see inflation remaining as growth weakens. I think what's unknown, and there are some signs this may well continue, is as growth then begins to recover, do we go back to a much more normal inflationary cycle? We've been in a pretty unusual period of very low inflation for quite a long time, the great moderation. So do we get back to, and that is about expectations, that people start to think, well, actually inflation, I haven't seen inflation in 20 years, but now I'm beginning to see it. Then that feeds into wage expectations, it feeds into cost inflation, and then you start to get a bit of that cycle back. I suppose, one of the hardest things about if you're treating supply side inflation as demand begins to fall away is it's not something that monetary policy can easily tackle, because to cope with inflation, you're going to begin to tighten. That does nothing for your demand side support. So, that combination, I think is challenging. So I think those are just some scenarios as to how it can play out. But as Douglas says, he was there in the 1970s, so maybe he'll give us a sense as to whether or not I could actually.
Thank you, and Linda, you mentioned climate change earlier, and I don't think we can have any discussion of any kind nowadays without mentioning that. So I wanted to link it to inflation a little bit, because I think it potentially is relevant, and Dilip was already explaining to us very clearly how energy prices are going down, even though we do have the cap in April that will increase potentially prices a little bit in the short term. But isn't it, I mean, one of the things that we're looking at a little bit is the fact that now that we're going to have less investment in the more traditional, if you like, dirty energy sources, despite the super deduction and everything else that the government is throwing at us for the short term, aren't we going to potentially have more volatile energy prices? And is this something that we should think about? And also, is there anything else from our transition to net zero that we should factor into these forecasts? And that's probably less than half a minute each, starting with Linda.
Okay, so 30 seconds on this. So I think the net zero transition requires a moving away from fossil fuels into a greater share of renewables. Any transition is going to have, structural change always has dislocations. And we did have a taste of that just a few months ago. We had the lowest amount of wind since the 1960s, and then coupled with factors driving up energy prices, and I think we saw what kind of disruptive forces energy can play, on inflation, on, potentially, going forward. So I would just say, yes, the net zero transition, like any transition, we need to factor in greater volatility, and you should see that in terms of price impact. But what I said before is it's important to keep an eye on core inflation, because these are more volatile items, energy and food, and they don't necessarily last. But that being said, the net zero transition will be with us for some time. So, it's like Keynes said, in the long run, we're all dead. And so we say, oh, well, it won't last. Well, actually, it could last for quite a long time. And that in itself is worth noting in all your forecasts, I think.
Thank you. Douglas, and there's also another comment from Timothy you may want to just address quickly. I don't think you will be able to list it.
Tim wants to argue about whether wages cause inflation. I think the best place to do this is in a pub somewhere, and I will arrange to meet him in a pub to do that. On the climate change thing, I think there are two issues. One is the cost of transition, to which Linda referred. We made an estimate that it's going to be about 5 trillion a year. World GDP for the first time ever is going to hit 100 trillion next year. So that's 5 trillion is quite noticeable as a level of investment. However, some other investments will be squeezed out, some of which are the fossil fuel investments that both of you just been talking about. So the net is not quite as bad as all that, but that is going to work its way through probably into cost to some extent, and we're assuming that will be there. And you've also got the costs of extreme weather events. There have been 18 that have cost more than $1 billion in the US alone so far this year. In a normal year, you have 6. So it does look as if the costs imposed by the climate are going up. And if we get rising sea levels, then they're going to go up exponentially.
Thank you. And Dilip, we literally have less than a minute to close. So if you just want to say a few words on net zero.
I mean, net zero, I don't think it is the net zero. You can attribute that to this year's kind of high energy prices. This has been because the economy effectively wasn't prepared for the kind of how demand came back and how quickly the lockdowns were ended. So it's more of a supply side rather than policy issue. I think there is a medium-term issue, though, that I think what we're trying to do is take out all fossil fuels, whereas a smarter approach would be to kind of take action against the most dirty ones first, like coal and oil, and kind of rely on natural gas. So one missed opportunity is we're not going for shale gas in the UK, but that's 4 times cleaner than coal. It's twice as clean as oil, roughly. But we should, I believe, be using natural gas more in the 2020s until our kind of purely green technology, like the new kind of mini nuclear plants, which aren't going to be affected so much by climate and would be a reliable source of energy. These come on stream around 2025 onwards. So by 2030, we would be able to do proper decarbonization. But in the interim, I think we're making a mistake by kind of discouraging natural gas use.
Okay. Thank you. Well, we've run out of time, literally. So thank you so much for all your forecasts and very eloquent answers to all the questions. And I remind all the participants to submit their responses to the quiz as early as possible. And there's the forms available in the chat, I believe, and also on the website. So without further ado, let's have a good evening, everyone, and safe and merry festive season to all of you, and hopefully very good luck with the competition and with next year more generally. Take care.